What is technical analysis? Predicting price movements in the financial markets by using historical price and volume statistics. It is based on the idea that if a trader can identify previous market patterns, they can form a fairly accurate prediction of future price trajectories. Why should you use technical indicators? Technical indicators are used to see past trends and anticipate future moves. Technical works on logics and pure mathematics and applicable on all asset classes. Technical indicators also give support and resistance levels, short-term and long-term horizons. How to read stock charts? Simply put, a stock chart is a graph that shows you the price of a stock over a specific period of time. A stock chart becomes particularly useful when you know how to read its information and decipher what it's showing so you can make more accurate predictions about how the stock will perform in the future. Here are the 4 key data points you need to understand in order to fully leverage the power of a stock chart. Identify the trend line. Look for lines of support and resistance. Know when dividends and stock splits occur. Understand historic trading volumes. How many different kinds of charts are there? These are the 4 most commonly used charts for day trading: line charts, candlestick charts, bar charts, point and figure charts. Which are the different types of trading styles? There are 4 main types of trading styles. Scalping. For short-term trading, scalp traders only hold positions open for seconds or minutes at the most. These short-lived trades target small intraday price movements. Intraday trading. Day traders enter and exit their positions on the same day, removing the risk of any large overnight moves. At the end of the day, they close their position with either a profit or a loss. Swing trading. Swing traders typically hold positions for several days, although sometimes as long as a few weeks. Positional trading. Positional traders are focused on long-term price movement, looking for a maximum potential of profits to be gained from major shifts in prices. Understanding trends. A trend is the overall direction of a market or an asset's price. In technical analysis, trends are identified by trend lines or price action that highlight when the price is making higher swing highs and higher swing lows for an uptrend, or lower swing lows and lower swing highs for a downtrend. How to use trend lines? Trend lines are a key part of delving into technical analysis and trading of charts. When used correctly, they are a helpful, clear and relatively simple tool for traders. When the price rises, the trend line rises accordingly. When the price falls, the trend line falls. A trend line is a line drawn over pivot highs or under pivot lows to show the prevailing direction of price. Trend lines are a visual representation of support and resistance in any time frame. They show direction and speed of price and also describing patterns during periods of price contraction. What are support and resistance levels? Support and resistance levels can help traders gain extra insight into the strength of a price trend. Support and resistance are terms for 2 respective levels on a price chart and appear to limit the market's range of movement. The support level is where the price regularly stops falling and bounces back up, while the resistance level is where the price normally stops rising and dips back down. The level exists as a product of supply and demand. If there are more buyers than sellers, the price could rise, and if there are more sellers than buyers, the price tends to fall. What is a breakout strategy? A breakout trader is a type of trader that uses a breakout strategy. This strategy looks for levels of areas that a security has been unable to move beyond and waits for it to move beyond those levels. When a price moves beyond one of these levels, it is called a breakout. Many breakout traders use technical analysis to identify these areas, often using trend lines or price patterns. A breakout trader looks for patterns, for example, instances where price of a security has been resistant to moving above or below a specific price level or price area. Then the trader attempts to profit by entering a trade in the breakout direction, assuming that the price will continue to move in that direction. What are candlestick patterns? Candlestick charts were originated in Japan over 100 years before the West had developed the bar charts and point and figure charts. The candlesticks are used to identify trading patterns that help technical analysts set up their trades. It has three basic features: the body, which represents the open to close range, the wick or shadow that indicates the intraday high and low, the color, which reveals the direction of market movement. A green or white body indicates a price increase, while a red or black body shows a price decrease. What are gaps in technical analysis? A gap is an area of discontinuity in a securities chart where its price either rises or falls from the previous day's close with no trading occurring in between. Gaps typically occur when a piece of news or an event causes a flood of buyers or sellers into the security. It results in the price opening significantly higher or lower than the previous day's closing price. Depending on the kind of gap, it could indicate either the start of a new trend or a reversal of a previous trend. There are four different types of gaps: common gaps, breakaway gaps, runaway gaps, and exhaustion gaps, each with its own signal to traders. Different types of candlestick patterns. Bullish patterns may form after a market downtrend and signal a reversal of price movement. They are an indicator for traders to consider opening a long position to profit from any upward trajectory. Hammer. The hammer candlestick pattern is formed of a short body with a long lower wick and is found at the bottom of a downtrend. A hammer shows that although there was selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary. Inverse hammer. A similarly bullish pattern is the inverted hammer, the only difference being that the upper wick is long while the lower wick is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market's price down. The inverse hammer suggests that buyers will soon have control of the market. Bullish engulfing. The bullish engulfing pattern is formed of two candlesticks. The first candle is a short red body and is completely engulfed by a larger green candle. Though the second day opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. Piercing line. The piercing line is also a two-stick pattern made up of a long red candle followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price and the green candlestick's opening. It indicates a strong buying pressure as the price is pushed up or above the mid price of the previous day. Morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a three-stick pattern. One short-bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding and a bull market is on the horizon. Three white soldiers. The three white soldiers pattern occurs over 3 days. It consists of consecutive long green or white candles with small wicks which open and close progressively higher than the previous day. It is a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. Bearish candlestick patterns usually form after an uptrend and signal a point of resistance. Heavy pessimism about the market price often causes traders to close their long positions and open a short position to take advantage of the falling price. Hanging man. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. It indicates that there was a significant sell-off during the day, but that buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. Shooting star. The shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a small lower body and a long upper wick. Usually, the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open. Like a star falling to the ground. Bearish engulfing. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle. It signifies a peak or slowdown of price movement and is a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. Evening star. The evening star is a 3-candlestick pattern that is equivalent to the bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candle. It indicates the reversal of an uptrend and is particularly strong when the third candlestick erases the gains of the first candle. 3 black crows. The 3 black crows candlestick pattern comprises of 3 consecutive long red candles with short or non-existent wicks. Each session opens at a similar price to the previous day, but selling pressures push the price lower and lower with each close. The traders interpret this pattern as the start of a bearish downtrend, as the sellers have overtaken the buyers during 3 successive trading days. Dark cloud cover. The dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over previous day's optimism. It comprises 2 candlesticks, a red candlestick which opens above the previous green body and closes below its midpoint. It signals that the bears have taken over the session, pushing over the price sharply lower. If the wicks of the candles are short, it suggests that the downtrend was extremely decisive. If a candlestick pattern doesn't indicate a change in market direction, it is what it is known as neutral pattern. These can help traders to identify a period of rest in the market when there is a market indecision or neutral price movement. Doji. When our markets open and close are almost at the same price point, the candlestick resembles a cross or a plus sign. Traders should look out for a short or non-existent body with wicks of varying length. The doji's pattern conveys a struggle between the buyers and sellers that results in no net gain for either side. Alone, a doji is a neutral signal, but it can be found in reversal patterns such as bullish morning star and bearish evening star. Spinning top. The spinning top candlestick pattern has a short body centered between wicks of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher while the bears pushed it low again. Spinning tops are often interpreted as a period of consolidation or rest following a significant uptrend or downtrend. On its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come, as it signifies that the current market pressure is losing control. Which are the different types of technical indicators? Trend indicators. The market either goes bullish or bearish, but how strong is the trend or how long will the particular trend continue? In general, the averaging baseline is formed using one or more average-based indicators. By viewing the price movement with the baseline, if the price moves above the baseline, it depicts the strong bullish trend. On the other hand, if the price moving or trending below the baseline gives the sign of a bearish trend. A few examples of trend indicators are moving averages and parabolic SAR. Momentum indicators. These types of technical indicators help in identifying the speed of a price movement over a certain period of time. In this case, the closing prices play a major role, as a calculation for this indicator is done by considering the difference between the current closing price and the previous closing price of a stock. The value calculated with the difference is ultimately in understanding the strength and weakness of the stock price. The momentum indicators help in determining the speed with which a particular stock price can increase or decrease. A few examples of momentum indicators are RSI and stochastic oscillators. Volatility indicators. As a term, volatility suggests the degree of variation in the price movement of the stock. Volatility indicators are the technical tools used to measure this price fluctuation of the stock. This measurement of the variation is regardless of the direction of the price movement and is usually calculated based on the highest and the lowest historical price data, due to which a defined range is determined in which the price usually fluctuates until the breakthrough happens. This is the range in which investors or traders can either go long or short in order to gain profits. A few examples are Bollinger Bands. Volume indicators. As the name suggests, volume indicators are the technical tools that help in measuring the strength of a trend of any particular stock. Volume indicators are used alongside with other indicators. It is said that when the volume increases, it signals towards a strong trend. These volume indicators in technical analysis are the most common that the traders use to understand the strength of a trend along with small price fluctuations. A few examples are on-balance volumes, also known as OBV. What is RSI? The Relative Strength Index (RSI), developed by J. Wells Wilder, is a momentum oscillator that measures the speed and change of price movements. The RSI oscillates between 0 and 100. Traditionally, the RSI is considered overbought when above 70 and oversold when below 30. Signals can be generated by looking for divergence and failure swings. RSI can also be used to identify the general trend. What is Dow theory? Dow theory was first introduced by Charles Dow, who was the founder of Dow Jones and Company. The theory explains how the stock market can be used by investors to understand the health of the business environment. It was the first theory to explain that market moves in trends. And while a lot has changed in the stock markets over the years, the basic tenets of Dow theory still hold water. There are total 6 tenets of Dow theory. The market discounts all news. The market has 3 trends. Trends have 3 phases. Indices confirm each other. Trends are confirmed by volume, and trends continue until a reversal signal. Stochastic. The stochastic indicator followed by the momentum of the price of an asset. As a general rule of thumb, the stochastic oscillator is calculated by taking a 14-day time period as the standard. However, the time period can be changed and adjusted according to your specific needs as well. The value of the stochastic indicator for any specific time period is always between 0 and 100. This indicator is used to identify overbought and oversold trading signals for any asset, thereby enabling you to spot reversals in the price action. For instance, if the value of the stochastic indicator for an asset is more than 80, the said asset is considered to be in the overbought region. If the value is less than 20, the said asset is said to be in the oversold territory. However, the indication of overbought and oversold territories should be merely be taken as clues to future price movements and not as conclusive evidence of a reversal. The stochastic chart contains 2 lines. One line showing the actual value of the oscillator and the other is the 3-day moving average of the previous line. These 2 lines move in tandem and generate trading signals when the slow moving stochastic line crosses the moving average line. Different types of moving averages. A moving average is one of the lagging technical indicators which the traders and investors use for determining the trend's direction. The various types of moving averages are simple moving average. The SMA is the simplest moving average that is obtained by adding the most recent data points set and then dividing the total by the number of time periods. The next is exponential moving average or the EMA. EMA is the other type of moving average that gives more weight to the most recent prices points and makes it more responsive to recent data points. Then we have the weighted moving average, the WMA. WMA is another type of moving average which traders use for generating trade direction and making a buy or sell decision. It gives greater weightage to the recent data points and less weightage to the past data points. And finally, you have the double exponential moving average, DEMA. DEMA is an improved version of EMA as it allocates more weight to the most recent data points. It reduces lag results and is more responsive, that helps short-term traders in spotting trend reversals quickly. How to use moving averages? Moving averages are calculated to identify the trend direction of a stock or to determine its support and resistance levels. Short-term moving averages are typically used for short-term trading, while long-term moving averages are more suited for long-term investors. A rising moving average indicates that the security is in an uptrend, while a declining moving average indicates that it is in a downtrend. Similarly, upward momentum is confirmed with a bullish crossover, which occurs when a short-term moving average crosses above a longer-term moving average. Conversely, downward momentum is confirmed with a bearish crossover, which occurs when a short-term moving average crosses below a longer-term moving average. How to use MACD? The moving average convergence divergence indicator is a momentum oscillator primarily used to trade trends. Although it is an oscillator, it is not typically used to identify overbought or oversold conditions. It appears on the chart as two lines which oscillate without boundaries. The crossover of the two lines give trading signals similar to a two-moving average system. MACD crossing above 0 is considered bullish, while crossing below 0 is bearish. Secondly, when MACD turns up from below 0, it is considered bullish. When it turns down from above 0, it is considered bearish. When the MACD line crosses from below the above signal line, the indicator is considered bullish. The further below the 0 line, the stronger the signal. When the MACD line crosses from above to below the signal line, this indicator is considered bearish. How to use Bollinger Bands? Bollinger Bands are envelopes plotted at a standard deviation level above and below a simple moving average of the price. Because the distance of the band is based on standard deviation, they adjust to volatility swings in the underlying price. Bollinger Bands use two parameters, period and standard deviations. Standard deviation, the default values are 20 for period and 2 for standard deviations, although you may customize the combinations. Bollinger Bands help determine whether prices are high or low on a relative basis. They are used in pairs, both upper and lower bands in conjunction with a moving average. How to use the central pivot range? Central pivot range is a tool for technical analysis. Traders use it intraday trading as an efficient trading indicator. Central pivot range (CPR) indicator is used to identify key points of price levels and trade accordingly. Traders can take up trading positions based on the different levels on the chart. It is quite popular among traders as it is quite versatile and is simple to understand. CPR indicator has 3 levels that are pointed on the chart. These levels are pivot points, top central pivot point and bottom central pivot point. There are two basic concepts that need to be understood to understand the CPR indicator. These are trading charts and candlestick patterns as well as support and resistance. The former is used to identify the critical breakout points at price levels. Support and resistance help the trader identify the lowest and the highest price levels that can be reached for any stock. It safeguards the trader against potential losses and limits them. How to trade on Fibonacci retracement? Fibonacci retracement highlights levels which help us identify potential reversal area, thus identifying potential entry point after a pullback. The retracement can be applied both after an uptrend or a downtrend to identify probable reversal levels in the direction of the prior trend. The most popular Fibonacci retracements are 38.2, 50% and 61.8 and 78.6%. These Fibonacci retracement levels create a good opportunity for the traders to make new positions in the direction of the trend. The important Fibonacci ratios are 23.6, 38.2, 50 and 61.8% retracement, which help traders to identify the probable extent of the retracement and position himself for the trade accordingly. How to trade on the Fibonacci extension? Fibonacci extension is drawn by joining 3 points, unlike Fibonacci retracement, which just has 2 points, by joining the lowest and the highest points of a predefined trend and vice versa. Let's understand how we can draw Fibonacci extension in case of an uptrend. You need to join the lowest and the highest point, and thereafter a retracement or a correction, the price continues in the direction of the original trend. The low of the retracement or a pullback would be our third point. The most common Fibonacci extension levels are 161.8, 261.8 and 423.6%. Though the ratio may be a little distorted at the beginning of the sequence as a number gets bigger, the above approved ratio appears. Common trading mistakes to avoid. Trading seems so simple. After all, a price can only go up or down. So all traders have to do is pick the right direction, then sit back and wait for the money to roll in, right? Well, not quite. The trading world can be full of surprises for those who have big ideas but little in the way of preparation. When ill-prepared, traders won't recognize that mistakes in trading are all a part of a learning process and can actually shape a person into becoming a successful trader. Some of these mistakes are more costly than others. And the fact is, there are some mistakes that are hard to accept. And for some traders, ignoring a mistake and repeating it over and over again can spell the difference between becoming a successful trader or a losing one. A few of these mistakes are trading without a trading plan, trading too much too soon, emotional trading, guessing, not using a stop-loss order, over-leveraging, revenge trading, not tracking trades in a trading journal, following the crowd, trading in multiple markets at once, and FOMO. Understanding Supertrend Study. As the name suggests, it indicates the direction of the price movement in a market that is trending, that is following any particular path. A supertrend indicator is plotted on either above or below the closing price to signal a buy or sell. The indicator changes color based on whether or not you should be buying. If the supertrend indicator moves below the closing price, the indicator turns green and it signals an entry point or point to buy. If a supertrend closes above, then the indicator shows a sell signal in red. In this series, we have covered all the frequently asked questions about technical analysis. Thank you for watching Ticker TV, and for more such updates, stay tuned.